Okay, G, thank you for speaking with me today. It's great to talk to you about mum and dad home loans. Firstly, can you tell me a little bit about what mum and dad home loans actually do?
Yeah, sure. Kerman, thanks for having me. Um, Mum and Dad Home Loan started almost a year ago, and I've been in the industry for the last 7 years.
Oh,
I was
okay.
working with one of the bigger banks, and working with one of the bigger banks, everything was good, but the fact that there was this, I wanted to help mums and dads and give them more options and help them grow their portfolio. And you kind of can't do that if you're working for that one bank only.
Sure.
So the idea behind Mum and Dad Home Loans is to help mums and dads grow their portfolio, grow their wealth through property developments, through investment in properties, through sometimes as simple as restructuring their debt and refinancing it to help them save money and pay off their loans quicker.
Okay.
That was the main idea behind Mum and Dad Home Loans.
Okay, so what is the difference between what is development finance, and what is the difference between development finance and regular investment loans?
Yeah, sure, Kerman. Great question. A development finance is a type of loan that helps fund your building and development costs for a project. Now, depending on the type of project you're doing, there are a few different options available. Some of them include getting finance for land acquisition, construction, and then residual debt after the project is completed. The different aspects and stages of property development that a developer has to go through, and each stage is funded by the banks in a certain way. This is where my expertise and experience comes in as well. There are so many hurdles that the bank makes you jump through, and having someone like myself on your side to help guide you and you do all the following up for you make it hell of a difference, and you get to spend time doing things that you actually love instead of chasing banks, which I know no one likes to do. So there are different LVRs, loan to value ratios, that apply as well to different projects, and the factors that determine the LVR include, but not limited to, obviously the experience of you as a property developer, the financial strength of the developer, how much equity you bring to the project, the location of your proposed development, how much money you're going to make, so the profitability, your builder you have hired, their experience and capacity, how much pre-sales you're doing or pre-leases, and the exit strategy that you may have, and what kind of development it is. Could be residential or commercial. Now, you asked me the difference between investment loan and a development finance loan. I guess the major difference is between a regular investment loan and a development finance that, unlike an investment loan, where the bank gives you the money for the next, say, loan term of 30 years, development finance is usually given depending on the project completion timeframe. Interest rate is obviously a bit higher because it's not unlike investment loan, it's considered a commercial loan. The interest, however, can be capitalized on a development loan, and therefore it gets added on the loan balance every month and is payable at the end of the project whenever you sell it, or if you decide to keep it, whenever you do a takeout debt at the end. So that kind of explains what the main difference is between development finance and a investment loan.
So what are the different options available to get a development finance?
So Kermit, there is a general misconception amongst people who want to get into property development that banks are the only way to go. If the bank says no, they think but the project can't be done. This is not correct at all. You see, if you're doing smaller projects like, buy a house, knock it down, rebuild 2-3 townhouses or units, no issues. Most banks will be able to fund that for you, and provided that you have enough borrowing capacity or equity or deposit to put towards the project. But if you're doing bigger projects and your traditional bank says no, there are a lot of other options that you can explore. See, right now, most banks are tightening up on development funding. So some of the options include going to lesser known banks who work as mortgage managers sometimes and getting funds from them, or going through private funders who are nowhere near as strict or stringent on their lending policies, and generally speaking, don't even require as many pre-sales if the application is strong enough. Now, this is where I come in. I've got access to a variety of banks as well as private funders with different risk appetite who can help you get your project underway. You see, most of the time, it is about how you present your application and proposal to these guys that determines their decision to work with you. Now, working with someone like myself will help you get over that hurdle quite easily, as I submit the proposal to you by mitigating all the risk credit guys will consider. Another thing clients do these days is more like a joint venture with an experienced builder to reduce their risk, or look at mezzanine debt and preferred equity to fill in the gaps for bigger projects. Of course, these are more costly options compared to traditional banks, but if the banks keep their policies the way they are right now, the developers have very limited choice.
Who do you need on your development team to be successful then as a property developer?
Great question, Kerman. So, as a property developer, for someone who's just starting out, not so much obviously if you have been in the game for long enough, the main thing you need is a finance person like myself who can help you navigate through different options. If you can't get the finance for the property itself, all the other variables kind of don't line up. So the next person you need is an experienced builder who has done similar or bigger projects, an accountant that can help you structure everything in the most tax-effective way, an architect or draft person, an engineer, quantities aware, a project manager for the development, and real estate agents to market your project.
So what are the costs associated with a development project?
Sure, Kerman, the main costs that are associated with any development, and that's where we do the feasibilities as well initially, is your land and building acquisition cost. If you are doing a knockdown rebuild, or if you are acquiring an existing building and doing a bigger project on it, your construction or refurbishment cost, your stamp duty, of course, and the legal fees or professional fees, architect, engineering, quantity surveyor, special consultants that you might hire, finance cost, the actual interest that gets added on the top later on, or as we go month by month. Your marketing expenses, and mainly and the last one is the contingency allowances to make sure that there is a bit of a buffer in case things go wrong.
So could you tell me a little bit about what is the actual profit potential for a development project?
Sure, great question. Part of securing finance is being able to determine the profit potential of your development project, and that's what we call feasibility, basically. Now, what I do here is quite simple. Before I actually put an application together for a lender, the first step for me is to make sure that the clients will make money at the end of all this. So we do a very basic feasibility first to see if the project is viable and worthwhile. And generally speaking, after you've done your feasibility, there should be at least 15 to 20% profits for smaller projects, generally speaking, and that's bare minimum. Now, part of the funding process involves a feasibility study conducted by the lender's valuers anyway to determine the profit margins. Now, this step is critical in determining profitability and its acceptance to the lender. So overall, it's about understanding what your goals are in relation to how you see yourself at the end of the project, where you see yourself at the end of the project in regards to the profitability, and we work our way backwards.
That's really handy information to know. Can you tell us though a little bit more of the different stages of development and how are they actually funded?
Kerman, the development loans offer staged payments to be finalized at the end of each regular building stage. Mainly just like a normal construction loan. You've got your deposit stage, you've got your base stage, you've got your frame stage, lockup stage, fixing stage, and the end of the balance of the development funds, the actual loan amount that you've got, is supplied on the completion of the project. So the banks basically do different valuations at certain, or the lenders might have the valuations done at different stages to make sure the project is being done according to the plans. But these are the main 5 or 6 stages in any development.
Gee, thank you so much for talking to me today. It's really been really a mind-opening experience. Your final piece of advice though for someone who's looking to go into property development, or someone who is already a property developer, what's your final key piece of advice for them?
Kerman, my last piece of advice is it's always easier to get someone like myself involved in the process from start to finish, as I deal with the lenders throughout the entire process. And when it comes to the finance side of the project, all you have to do is let me handle that for you, so you can focus on all the other aspects of the development and do what you do best and enjoy the process. So if that's ever something that you need help with, check in with me, as I would love to have a chat with you. I would love to hear what you are up to right now and what projects you've got going on. So shoot me a message on the number below and let's keep this conversation going. Thank you for having me today.